In the late 1970s, China's economic landscape began to shift dramatically under the guidance of Deng Xiaoping. The country, known for its stringent economic policies, started to open up. Special economic zones popped up, and one such place, a modest town named Shenzhen, transformed into a megacity powerhouse. It's a story of rags to riches, or in this case, from farmlands to skyscrapers. But fast forward to today, and the whispers of economic turmoil are getting louder. So what's going on? First off, China's been the poster child for rapid economic growth, right? For years, it's been all about those double-digit growth rates. But recently, things have slowed down to around 5% growth. Now, 5% might sound like a dream to some economies, but for China, it's like Usain Bolt suddenly running a minute mile. It's not just about the number, it's about the pace they're used to. So why the slowdown? China has been on a building spree, constructing vast urban areas at a pace that outstrips the crowd they were meant for. It's as if they've been throwing a grand party, laying out a banquet for millions, and then somehow forgetting to send out the invitations. These are China's ghost cities. Immense and impressive, yet they stand in silence, waiting for a sign of life. These places have sparked both interest and worry from onlookers near and far. They're not like the ghost towns from Western stories, left behind after the rush for riches ended. No, these cities are brand new, built with the future in mind, hoping for a day when they will teem with life and activity. For now, they wait, poised for the moment when they will finally fulfill the purpose for which they were built. These ghost cities are a testament to China's unique approach to real estate. Here, homes are split into two categories: those meant for living, which you must occupy and can't flip for profit, and those you can trade like stocks, known as commodity housing. With China's massive population and the unending quest for homes, the latter has become a favorite investment. It's like planting seeds for a forest that's yet to grow, building homes not for today's needs, but for tomorrow's dreams. But why build cities that no one calls home? The answer lies in the vaults of local Chinese governments. By transforming rural fields into urban gold mines, these governments fill their coffers, selling plots of urban land at a premium. The rush for revenue has fueled a construction frenzy, birthing these under-occupied urban expanses. Yet these ghost cities aren't destined to remain hollow. They're not frozen in time, but may simply be ahead of it. Take Pudong in Shanghai, for instance. Once whispered about as a ghost city, it has since blossomed into a thriving financial hub, its pulse beating to the rhythm of global commerce. This transformation offers a glimmer of hope that today's silent streets may tomorrow echo with the laughter of children and the hustle of busy lives as part of a grander vision for China's urban future. These projects were banking on the idea that China's growth would just keep on chugging along. But here's the catch. The country's internal migration has been slowing down, and for the first time in a long while, China's population growth is stalling. Now let's talk real estate. It's been the go-to investment for many in China, from the government to grandma saving for her grandkids' future. But with the slowdown, these investments are starting to look shaky. And when real estate, which is a huge chunk of the economy, starts to wobble, it's like a domino effect. Now let's wind the clock back to 2021. Remember the drama with China Evergrande Group? The big real estate player found itself in hot water, unable to pay its debts because of some new borrowing rules. That was like a red flag waving, hinting that something's fishy in the real estate pond, maybe a debt crisis brewing under the surface. Fast forward to 2023 and it's not looking any brighter. The property market is going through a rough patch, and it's not just a China problem anymore. The world is watching. The real estate sector, which used to be a big slice of China's GDP pie, around 29 to 30%, is now looking quite wobbly. And the proof is in the pudding. From January to August 2023, property sales in China took a 7.1% dive compared to the same period the previous year. The bucks poured into the real estate sector are also on a downward trend, showing that confidence is somewhat in the doldrums. Now, here's the twist. There's chatter about a change in the wind regarding real estate policies in 2023. You see, the Chinese government has always seen houses more as homes rather than a chance to make a quick buck, aiming to keep housing and land prices steady. But with the current real estate blues, they might be tweaking the rules a bit, although it's still a bit hazy on what those changes could be. However, At the crux of the worry is how China's growth has been fueled by debt. For a good while, China poured money into building stuff and boosting its property market to keep the economy bustling. This debt-driven game plan did wonders until exports started to slow down, riding the same wave as the global economy. Now, folks are beginning to question how solid this approach is. Just to give you a sense, local government debt shot up to a whopping 92 trillion yuan, $12.58 trillion, making up 76% of the country's economic output in 2022, a big jump from 62.2% back in 2019. Now, a big chunk of China's debt drama is wrapped up in its property market. The property sector, where a lot of Chinese families have their money tied up, is facing a slowdown, and this is spilling over into other areas of the economy, making the debt dilemma even worse. The money poured into property has been shrinking, with a further 8.8% dip this year until August, following the downward trend from the past few years. And let's not forget about companies like Country Garden, sitting on close to $11 billion of offshore debt, edging closer to a default, which could spark one of China's largest corporate debt overhauls. The present-day economic scene is kind of unique compared to China's past economic hiccups. In earlier global financial rough patches, China managed to bounce back by ramping up infrastructure investments and giving a nudge to property market speculation. But now, these moves have piled on more debt, casting shadows over financial stability today. Adding another layer to the puzzle is the low spending by households, spotlighted as a major imbalance in an economy that's been leaning hard on debt-backed investments. This tug-of-war between spending and investment is a bit of a throwback to what Japan went through before it hit a lost decade of stagnation in the 1990s. There have been attempts like cutting interest rates to ease the economic strain, but how well these will work, especially with the towering municipal debt and the big question mark on the government's readiness for a hefty fiscal boost, is still up in the air. As China wrestles with these financial hurdles, the world is watching keenly since China holds a significant seat at the global economic table. The debt issue, pegged at $9 trillion, isn't just China's headache, but has a broader worldwide significance. Adding to their economic jigsaw is the specter of deflation. Deflation is when prices keep dropping, and it can put a damper on all the buying and selling, which is the lifeblood of an economy. It's like a domino effect. People spend less, companies make less stuff, jobs get cut, and salaries shrink. This isn't China's first rodeo with deflation, but it's coming back at a time when the country is dusting itself off from the pandemic, which kind of puts a question mark on how strong this recovery will be. Now, in July 2023, there was this tiny dip in China's Consumer Price Index, CPI, by 0.3% compared to last year, even though it nudged up a bit by 0.2% from the previous month. This dip is like a red flag that the economy is feeling a bit under the weather. Despite some moves to kickstart the economy, this deflation cloud is expected to hang around till the end of 2023, which is a bit of a downer for an economy that's been on a growth spree for decades. Deflation's ripple effects are a bit of a twister. At home, as prices tumble, companies are holding back on investments, and folks are keeping their wallets shut, all of which hits the economy where it hurts. This is kind of fueled by the fact that people, after going through tough lockdowns, are not in a rush to splash cash. And it's not just a China thing. The world's watching closely, especially countries that have tight economic ties with China, as what happens there could send waves across the globe. Besides deflation, China's also dealing with other economic headaches like a sluggish property market, high local government debt, and a lot of young people without jobs. All these challenges bundled together can paint a not-so-rosy picture for China's economic growth, unless there's a big push to get people spending and investing again. And let's not forget, China's not just any economy, it's a global heavyweight. So when China sneezes, the world catches a cold. From the Belt and Road Initiative to manufacturing, what happens in China doesn't stay in China. Transitioning from this broad spectrum of manufacturing to innovation and technology, China has been sprinting ahead in the tech race, carving a niche in sectors like 5G, artificial intelligence, and electric vehicles. This tech prowess isn't just a domestic affair. It's China's ticket to the global economic high table, fostering trade and partnerships with countries far and wide. Then there's the massive consumer market. With a population north of 1 billion, China's domestic market is a goldmine for businesses, both local and international. Even when external trade faces turbulence, the internal market provides a cushion, keeping the economic gears turning. Of course, the road isn't without its share of bumps. The rising debt, deflationary pressures, and a cooling property market are indeed red flags, but it's crucial to see the bigger picture. China's economic playbook has been one of adaptation and forward thinking, traits that will be pivotal in navigating the current economic maze. So, is China's economy about to collapse? Well, it's not that simple. Economies don't just collapse overnight. But China is definitely at a crossroads. The growth model that's been the wind in its sails for decades is being tested. The country is facing challenges that could redefine its future, and by extension, the global economy. What's certain is that the next few years will be critical, and the whole world will be watching. Stay tuned, and let's see how this story unfolds. If you found this breakdown helpful, give us a like, hit that subscribe button, and share your thoughts in the comments. Until next time, keep an eye on the horizon and stay curious, friends.